Good morning, everybody, and welcome to our autumn statement summary webinar. I'm Phil Hartley. Glad you could all attend today. And let's get it go. So just a little bit of housekeeping first. If you can't hear me via your computer audio, just see on screen now, we've got the login details for telephone access and the access code accordingly. Apologies if there's any technology issues today. We should all be familiar with how this works now, but you never know what might happen. So a little bit about me, as I'm one of the tax directors at Mitchell Charlesworth. Particularly I focus in more corporate tax matters, so group restructuring, mergers, acquisitions, R&D tax relief tend to be my main areas, but I've also worked with a lot of owner managed businesses, so a lot of crossover with income tax, etc., etc. Please don't hesitate to ask any questions during the webinar by the chat function. I'll answer all these at the end of the webinar, so by all means just keep asking the questions as we go along, and I'll try and get to as many of them as I can at the end. If I don't give you an answer in the webinar, I'll try and contact you outside post-webinar to provide you with an answer. And there's my email address if you just wish to contact me directly. Post-webinar, by all means, please feel free to do so, or contact your contact within Mitchell Charlesworth if you have any questions. Session's being recorded, and we'll circulate this along with the slides following the webinar. So what we're going to talk about today. So I'm just going to do a very quick recap on what we know is coming in and what announcements have been made previously that are coming in from the 6th of April 2024. I'm then going to focus in on the big ticket item to a certain extent within the press and how the national insurance reductions are going to impact net income moving forwards. Going to just touch on corporation tax and what is the current position at the moment with corporation tax, and in particular a little bit about associated companies, bit of a big change in that respect, and what does that mean. The other big ticket item for a lot of businesses, R&D tax relief. We're now getting a simplified relief, and I'm going to put that in inverted commas until we discuss that in a bit more detail. And what does that ultimately mean for businesses moving forward that do claim R&D tax relief? Capital allowances, full expensing being made permanent. What is that impact? And a little bit of planning that needs to be considered around that. Some of the other matters, just a bit of a brief overview of those that were announced, and then any questions at the end. So what do we know that's coming in from April 2024? So first bit is we know that the income tax thresholds are remaining the same. They're remaining the same up to the 27-28 tax year. So personal allowance remains the same at 12,570. Basic rate bands up at 50,270, 100 grand before you lose your personal allowance, and the additional rate band coming in at 125,140 pounds. The dividend allowance is reducing again. So for the 22-23 tax year, that's stood at 1,000 pounds, and it's reduced by a further 500 pounds, where it then will be maintained as it stands. There's no further reduction planned at the moment. And similar with the annual exemption for capital gains tax, that's come down from 6,000 in the 22-23 tax year, down to 3,000 pounds for 24-25, which is where we would expect it to be maintained again. Corporation tax rates, maximum of 25%, possibly as low as 19%. Onto that in a bit more detail shortly. And we know that the restriction on overseas expenditure in relation to R&D tax relief is coming in from April 2024. That was delayed from April 2023, but confirmation again in the statement that is coming in from April 2024. So where are we with income tax and national insurance changes? The last 18 months have been quite chaotic in this respect. We obviously had Liz Truss government where we got rid of additional rate bands, and then we've had those reversals and the health and social care levy and that being reversed. So where are we as it stands? So additional rate band is, as I just mentioned before, 125,140 pounds. So we're paying 45% income tax as soon as we've lost our personal allowance. As I probably mentioned, and some of you will be aware before, that personal allowance band of between the 100,000 and 125,140. It's a bit of a super tax rate. It can be as high as 60% on that circa 25 grand of income. And so obviously a lot of planning does tend to go around that point, and something to continue to be aware of. Basic rate of income tax remains at 20%. There was discussions and talk in the lead up that it was either going to be income tax on national insurance that changed and income tax could be reduced, but they've retained that at 20%. Obviously, about this time last year, it was talk of going down to 19%, and that got reversed as well. So that's remaining at 20%. High rate bands remaining at 40% as well. Dividend tax rates, they're still the same, no changes there. So basic rate band of 8.75%. High rate band 33.75%, and the additional rate band of 39.35%. As I just mentioned before, dividend allowance is reducing, so we're going down to £500 dividend allowance now, from what was £1,000 in this current tax year. And this is the big change mentioned in the autumn statement. So Class 1 national insurance is reducing from 12% to 10%. But that's coming in from the 6th of January 2024. So effectively, we've got about an 11.5% rate for the 23-24 tax year. And then from the new tax year, just a flat 10% rate from the 6th of April 2024. We've also got the change in Class 4 national insurance. That's been reduced down to 9% to 8% from April 2024. So that's not coming in sooner. That's coming in from April 2024. And same from April 2024, Class 2 will no longer be compulsory. So you can voluntarily still pay Class 2 national insurance. And what the government have made quite clear is that the benefits that come with Class 2 national insurance, which are state pension in particular, will still be given even if you don't make the contribution. So just something to be aware of for the self-employed individuals on the webinar today. Again, as I just mentioned before as well, important to note, personal allowance, national insurance threshold, they're at the moment locked in, remain the same until 2028. Known and talked a lot about as a stealth tax, because as wages grow and with inflation or above inflation, more and more people are being dragged into the higher rates of tax as a result, which is obviously a tax driver, a tax driving activity for the government as well. But until 2028, that is the position as it currently stands. So the next few slides are just a few graphs, a few tables of the impact of some of these announcements that have been made. And this one in particular is with the change of national insurance for the 23-24 tax year in particular. So pre-autumn statement, we had, if you want £30,000, you were getting £24,422 net income for the year. Because of the fact that the national insurance change is happening from the 6th of January 2024, this has resulted in an additional £88 of income at that level, and it tops out at £189 because the reduction from 12% to 10% is only on that effectively that basic rate band element of the income. So if you're a higher rate taxpayer, you will get a maximum relief of £189 and in this current tax year, and that's shown with the various different levels of income. In comparison, when we then look at the pre-23-24 position from the pre-autumn statement position for 23-24 in comparison to 24-25 net income position, and again, you see significant increases in income, topping out at £754. So if you're a high rate taxpayer, you will get a maximum of £754 of additional income if you're purely on a salary position. The position is different for dividends because of the reduction, again, that further reduction in dividend allowance. Everybody who's receiving dividends of a certain level is reducing their income by £43. So that's a reduction in net income at those various different levels, small in comparison to what we've had previously with dividends when we had the increase in rates and a significant reduction in the allowance, but nevertheless, still a reduction that needs to be taken into account. And what then tends to be asked as a main question is it still worth being on a small salary dividend position for owner managed business shareholders and directors, or should we be shifting onto a salary position? And this table is based on a comparison of the same cost to the company. So £30,000 salary, for example. We'll use a different one. We'll go £100,000 salary. What is the £100,000 salary is providing me with a net income of £67,803 at the same cost to the company. So that's paying the salary, paying the employer's national insurance, and then getting corporation tax relief on those payments. What at the same cost to the company would I get as income on a salary dividend option? And as you can see, for 100 grand, for example, actually you're going to get an additional £3,335 income. So it is still more beneficial to be on a small salary dividend option. And you can see that it kind of increases, then starts to bottom out between the 75 and 100 grand level. But between 100 and 125, it shoots up quite a bit. And that's just because when you've got 125 grand salary, you pretty much lost all your personal allowance at that point in time. But when it's at the same cost of the company, your actual income per tax return will be a lot less, your gross income, because you're not having to take as much income out of the business at the same cost to the business. So that it shoots up there to 6,557 and then starts to come back down again. But all in all, it's still more beneficial to be on a salary versus dividend perspective, still be on a salary and dividend strategy rather than an only salary position for your net income perspective. You can compare different ways of this. You know, you can compare it based on the gross income scenario and what additional income are we going to get versus the cost of the company. We tend to advise on this method because the company's not out of pocket in any way. Company's still paying the same amount no matter what. It won't be getting as much tax relief, but it's not paying any additional amount out as a result of that. So that basis is what we tend to advise upon, and just demonstrates still a more beneficial position in that respect. So corporation tax. So there wasn't much speculation prior to the Autumn Statement that actually the way that the Autumn Statement will work for businesses is to reduce corporation tax rates. And they've shot up obviously from 19% flat rate for everybody to a maximum of 25% for businesses that are having profits of over £250,000. If your taxable profits are below 50,000, still 19%. No cuts were announced in this respect. Between 50,000 and 250,000, tax at the marginal rate of tax. And I'll go on to how that is effectively what effective tax rate we're paying between those levels in a moment. And over 250,000 suffer 25% tax rate. Didn't change at all. Was talk about it, but it's ultimately not happened. And he's focused his relief for businesses via the capital allowances and the full expensing system. Just as a reminder, we've also shifted from 51% group company rules in determining corporation tax rates and quarterly instalment thresholds to associated company rules. So what we mean there is that previously, if you had a group structure in place, your threshold for, in particular, quarterly instalments, which is set at £1.5 million taxable profits, reduces by divided by the number of group companies that you have. So, for example, if you had three active group companies in total, that threshold for quarterly instalments would go down from 1.5 million to £500,000. What the shift from 51% group companies to associated companies does is means that as well as having the group companies being considered, it also considers companies outside of the group. So if a group of shareholders or individual shareholders have more than one company and they own them individually outright, then they're classed as associated potentially. And I'm going to go on to a little bit more details to how that is worked, what we mean by that, and what we need to consider in a moment. But as an example there, owning two companies personally, that would mean that the corporation tax rate thresholds, but so instead of being between 50,000 and 250,000, would reduce to 25,000 and 125,000. So just in terms of the marginal rate of tax, example based on a sole company here, no associated companies, and we'll come on to that in a moment. But what is the effective rate on profits between the 50,000 and 250,000? So at 50,000, as we said before, we're paying 19%, but the effective rate starts to go up as and when we're receiving more profits. So as you see there, 60,000 at 20.25%, 75,000 at 21.5%. so on, until we get to 250,000 at 25%. So it's effectively a slide, an upwards ladder. As you attain more profits, you will pay a higher rate of corporation tax as a result. So something to be aware of, something to think about. You may have a few companies, and obviously those thresholds come down, but where are profits sitting, and how can we plan to ensure we're paying the lowest rate of effective rate of corporation tax as possible across your business interests. So associated companies, and what do we actually mean by that? So associated company is where a company is under the same common control as another company or group of companies, or is substantially commercially interdependent on a company connected to the shareholders. Bit of waffle there, unfortunately, but ultimately, what do we mean by all this? So it's got to be an active company for one. So if it's a company that is dormant throughout a period, they're not counted in terms of determining how many associated companies there are. But importantly, overseas companies are counted. So you might be part of a worldwide group, for example, and the shareholders, ultimate shareholders of a company based in Germany, for example, may also have other interests as well outside of the worldwide group. And therefore, those companies would need to be considered as well. So dormant companies we ignore, overseas companies we include. Where we've got associated companies, we're talking mainly about, as I said, a common control. Who has control over certain businesses and therefore could be associated. So if you've got myself, for example, I have Phil Hartley Limited, and then I also have Phil Hartley 2 Limited, for example, and I own both in 100% same control, and we would be connected for the purpose of this, and therefore each company would have one associated company each. You also then go further than that. So let's say I've got Phil Hartley Sister Limited, which my sister owns, or I've got Phil Hartley's Parents Limited, which my mum and dad own, for example. You've then got to start looking at what your siblings or spouses or parents or grandparents own. Importantly, ignore brothers and sisters, ignore uncles and aunties even. It's very much spouses, siblings, parents and grandparents that needs to be considered. But that is only considered where we talk about substantial commercial interdependence. So if Phil Hartley Limited is substantially commercially interdependent on Phil Hartley Sister Limited, then we are connected for that purpose. And what do we mean by substantial commercial interdependence? So it can be defined in 3 ways effectively. We've got financial interdependence. So if one company provides financial support to another company, or each company has a financial interest in the same business, they will be financially independent. So for example, if Phil Hartley Limited loaned money to Phil Hartley Sister Limited, they would be financially dependent on Phil Hartley Limited, and therefore we're connected. Economic interdependence. So if one company's activities benefits the other company's activities, or they have common customers, or the companies have the same economic objective, they would be classed as economically independent. I think that last bit there, the same economic objective, well, most businesses' economic objectives is to make a profit. So that's a little bit too vague from my perspective to determine economic interdependence. So really, it's the first 2 that we need to focus in on. So for example, Phil Hartley Limited might manufacture widgets, and those widgets are specifically used by Phil Hartley Sister Limited, who then implement those into a particular product and sell that to market. Well, intrinsically, those 2 companies are linked. One's providing a crucial element of the production for an overall position of the other, and therefore it could be argued that there's economic interdependence there. Common customers is, you might both have Phil Hartley Limited, Phil Hartley Sister Limited, both supplying a service to one company ultimately, or a few different companies, both the same, slightly different service, but they've got very much the same makeup of customers. That could be classed as economic interdependence as well. And then finally, there's organizational interdependence. So do the companies have the same common management, common employees, premises, equipment? Then that would be classed as organizationally interdependent. Important to note, it's only one of the above 3 that needs to be met. So You know, if you have financial interdependence, then you're associated. If you have economic interdependence in its own right, you're associated. It's not you need all three, it's you need one of the three. There's quite we're coming up with a bit of a solution around this, because there's certain things that we as your accountants and advisors will know, but equally there might be some things we don't have a clue about. So we are pulling together some fact sheets, some information to help you determine that position, and provide us with information to help us determine that position. So we will send those around as and when they are ready to, and include those in year-end account preparation, etc., for our clients. One of the big changes is R&D tax relief, and I flippantly said before simplified relief, because it's not quite simplified, far from it in that respect, and I'll go on to why that is the case. But a lot of press around R&D tax relief in the last 12 months or so, and a lot of people will know here that there's been a significant number of inquiries, particularly into the SME scheme by HMRC. HMRC have uplifted what they believe to be fraudulent, number of fraudulent claims, and it's a significant volume of a significant amount of money, talking circa £1 billion that they think in fraudulent or incorrect claims. So a lot of chat and discussion as to, well, what can we do to mitigate this position? How do we control this more ultimately? And with this in mind, from accounting periods beginning on or after the 1st of April 2024, really important now. So it's not from the 1st of April 2024, it's only for an accounting period beginning on or after the 1st of April 2024. There will be a merged R&D scheme that is based on the current RDEC scheme. So we've got the SME scheme and the RDEC scheme currently, and they're merging both of those schemes into one merged R&D scheme. Within this merged R&D scheme, there will be some of the beneficial elements of the SME scheme. So, for example, subcontractor costs or contracted out R&D costs aren't allowable within the RDEC scheme, but are within the SME scheme. In the new merged scheme, they'll be allowable full stop. In the RDEC scheme, the amount of credit you get currently is limited to your pay-as-you-earn, flat pay-as-you-earn, the NI position. Whereas in the SME scheme for the cash credit, it's £20,000 plus 3 times your pay-as-you-earn national insurance liability that the cash credit's capped at potentially. In the new scheme, it'll be based on the SME pay-as-you-earn and national insurance cap. So again, slightly more beneficial there. But the rate offered is less than the SME scheme. So the notional RDEC rate is 20%. So you've got, and I'll go into an example shortly as to how that works, but it's 20% rate, but this is classed as an above the line credit. So it's not below operating profit, it's above operating profit. It's almost as would be shown in the accounts potentially as other income in the year-end accounts. So that is subject to corporation tax. So effectively, it's potentially subject at 25%. So that's providing a net benefit of 15% for profit-making entities. One concession they have brought in here is that if you're a loss-making SME, so SME for R&D purposes is defined as either turnover over 100 million euros or net assets of over 86 million euros and employee numbers over 500. You've got to have 2 of those 3. So if you're a loss-making SME below those thresholds, actually the credit will be taxed at 19%, not 25%. So effectively, the net benefit would be 16.2% for loss-making SMEs. And as I mentioned before, restriction on overseas income, that is overseas expenditure even, will definitely come in from the 1st of April 2024. So you'll only be able to claim for R&D costs that have been incurred in the UK. So any cost you might have, for example, in mainland Europe or Asia or America, they will not be allowable for R&D tax relief moving forward. They will still be allowable for corporation tax relief, but they won't be allowable for any additional R&D tax relief. So, merge scheme and an example of the merge scheme. So I'm going to use an example of £100,000 qualifying expenditure that was been identified all in the UK, and that's what's been incurred by the business. That will provide a credit at 20%. So initially we've got a £20,000 credit in our computation. But as we mentioned just before, that credit will be is above the line and is subject to 25%. And in this example, we're going to assume that it's a profit-making company. Therefore, the net benefit will be £15,000. Now, that would reduce the corporation tax due. So it would be effectively a net benefit of £15,000. The corporation tax will increase because the credit is subject to corporation tax, but you've got £20,000 to knock off. So £15,000 net benefit for the business. And for a loss-making SME, the credit will be taxed at 19%, and therefore the net benefit would be £16,200. So the big question, what is the difference here? Why have they done this? And what is the difference between the SME scheme and in its current form and now this new merge scheme? And as you can see, that there is a significant reduction in relief here. This is on the basis of a profit-making SME scheme, SME business. So we'll move on to loss-making in a little bit more detail in a moment. But as you can see, as you go up, higher the R&D expenditure, the bigger the reduction in relief. So for £100,000, for example, you get, under the current SME scheme, you get £24,500 worth of relief, and that's reducing to £15,000 for accounting periods beginning on or after the 1st of April 2024. So a reduction in relief of £6,500 there. Quite significant, and it goes up effectively by £6,500 for every 100 grand worth of R&D expenditure. So big reduction, yes. Still worthwhile, in my opinion, yes. If you're undertaking the qualifying activities and undertaking the R&D work, there's still the benefit to be had from making the R&D claim. It just potentially isn't going to be as much as it used to be. When they said they've merged the two schemes together, they've merged two schemes into two schemes, because we also have a definition now of an R&D intensive company, and we touched on this previously in the last budget, because that's when it was initially announced, but I'll go over it again now just in a little bit more detail. So this is specifically marketed at SME schemes, mainly startups in particular, in all honesty, and very scientific intensive companies or technologically intensive companies. And you'll be classed, if you're classed as an R&D intensive company, you get a higher relief than under the merge scheme. You almost fall back into the old SME scheme, but for loss-making entities, and I'll go on to an example of that shortly. But for an SME to be classed as an R&D intensive company, it needs to be loss-making, one, and their R&D expenditure needs to represent at least 30% of their total expenditure in an accounting period. In the previous budget, the threshold was set at 40%, so they've reduced that threshold down to 30%, but you need to be an SME and you need to be loss-making. If you're not either of those, it doesn't matter how much expenditure represents the total expenditure on R&D, you won't get the relief. So if you're a profit-making SME that spends 40%, for example, on R&D, you're still under the merge scheme. It's very much aimed at loss-making and in that respect, more like your startups in that manner. What that would allow you to do as an R&D intensive company is utilize the SME cash credit regime. So it's providing a cash credit rate of 14.5% of the losses that are surrendered. And ultimately, what's the relief there is that it's a maximum relief of 26.97p for every £1 spent on qualifying R&D intensive activities would be available for the cash credit. So as an example, we're going to use 100 grand again, just an easy number. So under the R&D intensive scheme, for every £1 you spend, you get an extra 86p as an enhanced expenditure. And so that would give a total R&D cost for tax purposes of £186,000 in this scenario. So 100 grand actually spent plus the enhancement of £86,000. And the loss that can be surrendered is the lower of the corporation tax loss per the computation or the total R&D expenditure. And for this purpose, we're going to assume that the lower number is the total R&D expenditure. So the £186,000 is surrendered for the cash credit at 14.5%, and that provides a credit of £26,970. This amount over the initial R&D spend of 100 grand provides a benefit of 26.97p for every £1 that's spent on R&D. So for an R&D intensive company, the relief is much more, but it's very narrow now in terms of who it can be aimed at. You've got to meet the criteria very much on this. You've got to be an SME, you've got to be loss making, and you've got to spend at least 30% of your total expenditure on R&D qualifying activities. So much more narrow, but when they've said they've merged the scheme, they've then also created a further scheme. So we're still left with 2 schemes. And in my view, does that help with trying to tackle fraud? Well, the ones that are doing fraudulent activities are going to really try and hone in on trying to get the R&D intensive badge in that sense, because they get more relief. So do I think that helps? Possibly not. I think that's possibly open for a bit more discussion. It's been very much hastily brought in. We've only had 1 consultation on this. I think there might be a bit more feedback given to the government and a bit more tweaking on this in the future, I would suspect. So capital allowances and the full expensing becoming permanent. So a bit of background, March 23 budget, the super deduction was ending on the 31st of March 2023. So the full expensing system was announced then to effectively replace the super deduction. What the super deduction did was, for every £1 you spent on new and unused plant and machinery, you got £1.30 as a deduction against your taxable profits. What the full expensing system does is that for every £1 you spend on new and unused plant and machinery, you get £1 as a full expense. There's no upper limit. So it kind of works like the annual investment allowance, but annual investment allowance is open to all plant and machinery additions, full expensing purely for new and unused, and you get £1. The effective tax rate, tax relief even is the same, because the super deduction, it was a flat rate of 19%. So that £1.30 provided 25p near enough in the pound in tax relief, and the full expensing system provides a maximum relief of 25p in the pound, because we're at a 25% corporation tax rate. Said there, available for new and unused plant and machinery, provides 100% deduction against the company profits for the period. This was due to expire in March 2026, and a lot of the talk was, you brought this in, but actually businesses that are probably going to utilise this scheme are not planning potentially to spend that amount of money in the next 2-3 years, because there's more planning than goes into a big project that might benefit from this relief. You know, if it's a new manufacturing site, well, it could take 2 years before you've got planning in place, and then you've got to build the site, and then you've got to fit it all out. You've then potentially lost the ability to claim the full expensing system if it was to expire in March 2026. So confirmed in the autumn statement that this relief will become very much permanent, and it's envisaged that by 27-28 this will provide a £10 billion tax rate per year for companies. So very much a big ticket item, very much played upon. As Jeremy Hunt said in his statement, I think it's the most beneficial capital allowance now in the G7, and very much something that the government are honing in on in their autumn statement for growth. As I mentioned, annual investment allowance is still available at £1 million per year as well. So on items that do not qualify for full expensing, so that could be a used element of plant and machinery, or special rate pool items. And I'll come on to that in a minute as to why that's important. So impact and planning. What is the impact of this? So great that we've got the full expensing system that's permanent now, taking away that unease about the situation. But there is a bit of a catch to the full expensing system, in that what actually you need to do with the full expensing system is, say, for each asset that you've claimed the full expensing system on, you need to keep a separate log, which we will do on the tax computations for our client. But a separate log, and then when you sell that particular asset that you've claimed the full expensing on, that will automatically trigger something called a balancing charge. So effectively, any amount you receive or proceeds will automatically be charged to corporation tax at 25%, for example. Under the annual investment allowance, that's not the case. So if you've got a balance on your capital allowances main pool, the proceeds reduce that balance. So it is effectively taxing you, because you're not going to get tax relief in the future on the balance of the pool, but you're not getting an upfront tax hit potentially now as a result of that. Therefore, there's certain items that are allowable under the full expensing system So, for example, a commercial vehicle, which you might change every couple of years. Every time you change that, you're potentially then triggering a charge to corporation tax in changing that vehicle. And so in those scenarios, it's probably wiser to claim annual investment allowance until the main pool has been maximised in full and there's no balance left on the main pool. And again, something we will talk through with our clients. We'll explain why we're thinking of doing it in a certain way. But it's just a little bit of a catch with the full expensing system, that actually certain things that you might buy and then trade in, for example, in the future, actually could come with a tax hit further down the line, and something that we just need to bear in mind. With special rate pool items, you should only really utilise the annual investment allowance unless you're spending over £1 million, because the full expensing system for special rate pool items only provides a 50% relief. So when they say full expensing, it's not fully accurate, because the full expensing is only available for main pool items. Special rate pool items, so integral features, for example, and certain other elements of additions, only provide 50% relief. And important also to know that cars, so any cars don't benefit from the full expensing system. Electric vehicles do get 100% relief. If you're buying an electric vehicle, that's a separate relief rather than under the full expensing system. So just some of the other announcements that were made in the autumn statement. So just confirmation of in the March budget, we had a lot of information about pension contributions and the lifetime allowance being scrapped, and the charge being scrapped, and the annual allowance going up to £60,000, and just confirmation with some of the information released post-autumn statement that the lifetime allowance is being scrapped. So, and that's being abolished from the 6th of April 2024. I'd be careful, because I think if we get a new government next year, if it's a Labour government in particular, I don't think they'll be happy with that's gone, and they might want to reintroduce something. But there should be some protection that's offered if they do change that position. So just something to bear in mind. But yes, the lifetime allowance, which was standing at about 1.072 million as it stands, that will be abolished. Plastic packaging tax rate, something that will impact some of the businesses for sure on here. That is increasing from the 1st of April 2024 in line with the Consumer Price Index. So again, something to be aware of, something to take into account. EIS and Venture Capital Trust, VCT schemes, they have been extended for another 10 years, so they will still be in place now until April 2035. They were due to expire in April 2025. So again, something that's beneficial for people that have claimed EIS or EIS compliant shareholders, for example. Reform of the TV, film and video games tax relief is going to take place. Nothing in particular has been announced on that front, but what they are wanting to try and do is move it into more of an expenditure credit method, like the R&D merge scheme that we've just spoken about before. So consultation has been issued, documentation has been released on that. Nothing is set in stone as to when that's going to come into play, when that will be introduced from, but just something to be aware of at this moment in time. Business rates, small business multiplier, that's been frozen for a further year, and the 75% reduction for retail, hospitality and leisure sectors, that's been extended through to 24-25. And on free ports and investment zones, so the relief under the various different tax reliefs we've got under those zones have been extended from 5 years to 10 years. And there was a further 4 investment zones announced, so which include one in Wrexham and one in Greater Manchester as well. So again, something to be aware of, particularly planning on certain aspects for certain businesses. Investment zones might be something to utilise and make benefit of. So, just as in summary, it was a pitch, this autumn statement, as a statement for growth. But what was interesting really is that actually we've had a lot of growth and it gave the Chancellor a lot of headroom. But as a result of this statement, the OBR have actually downgraded growth predictions for future periods, which may not, so ultimately may not achieve what the government's intention was here. And equally, actually potentially stops it from happening any further in terms of tax cuts in the future, because the tax cuts and national insurance capital allowances are great, helpful for individuals and businesses without a shadow of a doubt. But actually, the OBR is predicting that the tax burden, which is what everybody's talking about in terms of government and politics, that's going to go even higher as a result of this autumn statement. So actually, yes, the headliners are tax cuts, but when you delve into the detail, that tax burden position is still becoming worse and worse, and it's going to be more difficult for the government as it stands to do anything about that, because growth isn't going to be as big as was once predicted. So what will happen in the future, I don't know, and it'll be interesting to see what happens. But as I said, we've got an election potentially in 2024, and at the latest by January 2025. So it'll be interesting to see how the government will try and do further tax cuts. Are we going to get a bit of a pre-election giveaway in the March budget? It's all open still for discussion. There wasn't any talk of inheritance tax this time and stamp duty, because it wasn't felt it was appropriate from a political aspect for inheritance tax and from an inflation point of view for stamp duty. Will that position change come March? It'd be interesting to see what they try and do. So yeah, thank you very much for listening.